Welcome to another episode of the Doctors Building Wealth podcast. Today we're going to talk about what the ultra wealthy know about investing that you don't yet. And so what we're going to be talking about is how the ultra wealthy invest. And I think a lot of us are really familiar with how we're told to invest as physicians or high income earners, but the ultra wealthy actually invest a little bit differently. And I don't think anyone really talks about that very much. Luckily, we attend a lot of circles where there are ultra wealthy people. And so we get to see what they're doing. And we also have actually seen some studies about how ultra wealthy invest versus the average American person. And so that's what we're really going to be diving into. What's the difference? And maybe give you some ideas about what you'd like to do differently in your investment portfolio to get in line with what these guys who have had a lot of success are doing with their investments.
Yeah, and then we'll contrast that with what the average investor invests in, and you'll see there's a huge difference between the two.
Okay, so let's first start out by talking about what you're probably doing and what you've been told to do as a physician investor or as a high-income earner. So most of us are taught, hey, take all your money, save it, have some cash on hand to be able to make it through a rainy day, and take the rest of it and put it in as much as you can into your retirement accounts and max out your retirement account. And then if you have some additional money on top of that, hey, put it in the stock market, right? Because you're going to get those returns, and then don't change things. No matter what the stock market does, just continue to put things into index funds and stay the course. Don't ever come out. Don't ever change things, no matter what the market is doing. Right? And so what we end up doing is 95% of our investments are in the stock market. Now, maybe we get a primary home, and you can argue whether or not that's an investment. It's primary home. But if you see a primary home as an investment, then, oftentimes primary homes, they're real estate, right? And so the value will generally go up over time. And so you will have some of your net worth tied up in your primary home, maybe some more of you than others, because you've been also told all debt is bad, right? And so you want to have no debt on your primary home.
Now, you've alluded to the fact that real estate is an alternative investment. So when you look at some surveys of how ultra high net worth individuals invest, you find that greater than half of their investments are in alternative investments. And you might be wondering, well, what are alternative investments? These are things like real estate. Real estate is a really big component of this. Other things might be private credit. So this might be not traditional lending, like lending for real estate and those types of things. So you might be wondering, what are these alternative investments? And real estate is one of the big components of alternative investments, but there are many others, like private credit is an example. Another one might be investing in commodities. Another one might be investing in life settlements. And we'll talk about some of these alternative asset classes in a little bit more detail, but these are very, very different than what a traditional investor, what the average investor is investing in. And a big part of this is having access to these types of investments. Another is simply education. And that's what we're doing here. We're educating you on these different asset classes that you could be investing in.
Now let's talk about why are ultra high net worth people doing multiple asset classes, whereas most of us are taught just put your money into stocks and into index funds. Well, the reason is, like many of us are feeling right now, when the stock market goes down, most of us who have 95% of our assets in the stock market get a big drop in our valuation of our assets. Whereas ultra high net worth people, when they have greater than 60% of their assets in alternatives, they actually have diversified. And so what we are often told is, hey, you diversify by being in the stock market and buying lots of different types of stocks. Well, that's really not true diversification. True diversification is, you have your stock market portfolio, but you also have things like real estate. Maybe you have some crypto. Maybe you have some private equity. Maybe you have some venture capital. Maybe you've invested in some startups. Maybe you have some art and collectibles. Like all those different things, you can imagine that's actually real diversification. It's not just investing in lots of different indexes in the stock market. And I think that it's just we're told something differently than people who really understand money and who really understand asset classes see. And one of the keys is that these are uncorrelated assets or fairly uncorrelated assets. So what does that even mean? What an uncorrelated asset is, if one asset goes down, that the other asset isn't tied valuation-wise to that asset, so it's not also going to go down, right? So if the stock market goes down, is real estate necessarily going to lose value? No, it's fairly uncorrelated. If the stock market goes down, is your art going to lose valuation? Probably not. So that's just an example of what an uncorrelated asset is. It means when one is affected, the other is not necessarily. And so luckily, we get to hear from Ray Dalio every single year at one of the conferences we get to go to. And Ray Dalio is always talking about having a whole portfolio of 13 to 15 uncorrelated assets. And he's talking about owning these assets that when one goes down, the other one go down. So you don't have that huge drop in your net worth when the stock market goes down. You actually have other things in your portfolio that are going to maintain their value or maybe even go up while the stock market's going down. And you actually can weather the long term, right? Because the biggest downside of having all your money in the stock market is you're 60 years old and all of a sudden the stock market takes a drop and you're retiring and you have no other assets. You're kind of stuck.
Yeah, I've actually seen that back in 2008 when stocks dropped significantly. It was the last major downturn, and I saw people who are close to retirement had the majority of their net worth in the stock market. And what happened? They had to work a number of more years. They were like, I got to go back to work. I thought I was going to be able to retire, but now I got to work another 5 years or 10 years to make up for the lost value in the stocks. And so it can have a very negative impact on somebody if the timing is the wrong timing. And so that's why as you get older, one of the things that you want to do is you really want to start thinking about diversifying and spreading out your money into these different asset classes so you are diversified, so you're not going to be hit by one asset class dropping significantly.
Yeah, and what's curious is a lot of people see the 2008 as a real estate market crash, and it truly was, right? Real estate overall lost value, but we searched it, and actually real estate only lost 15 to 20% on average of its value. It didn't lose like 50%. And I think a lot of us, Kenji, actually lived through 2008 while investing in rental properties. So he felt the experience of 2008, especially with the properties that were, really high cost, high rent per month properties and the raw land. But I think that we don't realize that it only went down 15 to 20%. And when you even think about the stock market more recently, it dropped 20%. Over the last few months. And so it can be that you can have a real estate downturn and it may not be necessarily as extreme as like a lot of us think that it will be.
Now, I think it's worthwhile. Now, we talked earlier about what are these alternative investments. So I thought it'd be worth going into some of these alternative investments so you have an idea of what these investments are. And the first one we talked about is real estate. And with real estate, there are so many different ways that you can invest in real estate. You can invest in rentals. You can invest passively. You can invest in the debt side of real estate where you are investing in the lending of money to real estate investors, right? So that's an area also known as private credit, where people are hard money lenders and they're lending money to investors who are then taking that money and buying real estate. So real estate is pretty diverse in itself, and there's also many different asset classes as well. So you can invest in multifamily, you can invest in storage units, you can invest in warehouses, lots of different types of investments in real estate. But again, real estate is just one alternative asset class. There's so many others, and we'll talk about those.
Yeah, I think it's important to just tell people that within the asset classes, you can get additional diversification. And that's what we were just talking about. And ultimately, diversification is great for protecting your wealth. It's great for keeping your wealth going long term. And that's really what we're focusing on during this podcast. We're not talking about increasing your wealth most rapidly, right? That's going to take some focus. That's going to take some knowledge and mastery in a specific area. That's how people grow their wealth, is they focus and they get really good at something, and that's how they grow their wealth. We're talking about diversification. And so, yeah, even within real estate, you can diversify, and that's just a small piece of your alternative assets. So there are others.
Yeah, so some others are commodities, and there are many different types of commodities. There's also gold and silver. That could be considered a commodity. Another one is crypto, right? That's another investment class that a lot of people are interested in. Venture capital, angel investing. Those are also some categories. These are some things that we've invested in as well. Then Leti mentioned some collectibles. She talked about art and also cars or watches. These are some things that could hold value. Whether or not it's a great investment is a totally different topic. That's not what we're talking about here. But we are talking about that it can be viewed as a store of value. And in some cases, certain collectibles can increase in value.
And then there are other asset classes that you just really don't hear about as an average person, like life settlements you mentioned, where you're actually investing in companies that go out and buy whole life policies from people. And then when those people die, they actually get the payout. Oil and gas is becoming more and more something that people are investing in. So you're starting to hear more about it. But for a long time, these kind of things were just, you don't even hear about it as an average investor, right? All you hear about the stock market, and you're missing all these asset classes that the ultra high net worth people have access to. Is it's important to note that some of these things you have to put minimums of like 250,000 or 500,000 or even $1 million into to be able to get access to these investments. And so that's why they're largely available to a lot of the ultra high net worth people and maybe not the average investor. But I think more and more people are kind of grouping together and being able to buy those asset classes as a group. I know that over in Fast Fire Capital, one of the things we did recently is we got together a small group of people to do an angel investment in a startup. And that wasn't something that was going to be available to the average investor without them putting on a fairly large chunk of money. Whereas as a group, we were able to do it for much, much lower.
Yeah, and I wanted to talk about access. And you might be wondering, like, well, why is it that the ultra high net worth have their portfolios are so different than the average investor? Why are they have more than 50% of their investments in alternatives? And a big part of it is access, and a big part of that is education in my mind. And so I wanted to talk about both. So the first one is education. And so, a lot of us, they don't teach finances. They don't teach investing in medical school or residency. They don't teach it in law school, engineering school, right? And so a lot of us are missing that education. So that's a big part of it, just not knowing or not being familiar with these different asset classes. And one of the things that we've been doing over the years is increasing our knowledge in these different asset classes. Obviously, we're very heavy into real estate, but we are also educating ourselves about a lot of other asset classes and gaining experience investing in those other asset classes. The other really big one is that access. And so, as you mentioned, one of the reasons why access is limited is because of the limit or the minimum investment that you have to make in order to get access to this. So I remember when we were first introduced to life settlements, the minimum investment was $250,000. We have an investment right now in a debt fund, and the minimum investment in that is $1 million, right? So it's just not accessible to the average investor. And so one of the things that we do, as you mentioned on Fast Fire Capital side, is creating opportunities so that people can get access to these investments. And the minimum is one of those, but I did want to mention that it's not just about the minimum. Sometimes it is just, you have to have a relationship with the person who is offering that investment. If you don't have the relationship, then you're not going to get access to it. And as you mentioned, that angel investment was an example of that. We had an opportunity to invest with a very experienced startup entrepreneur. And this person has extensive experience, has had numerous exits, has had numerous really big exits. And they brought this investment opportunity to us, and we were the very first investors in this new business that they were starting. And so again, that was just simply access, and that was from a relationship, and nobody else had access to that investment.
I think the other thing is there's a whole industry that really has developed around actually telling us that we don't have the time, we don't have the energy, we should be spending our time just being doctors and not learning this stuff and let them handle it. And so I really think that there has to be a mindset shift, which is like, hey, I am going to take some time to do this, right? I'm not just going to outsource this to somebody, to a financial advisor. I'm actually going to understand the bare minimum of it. I'm going to be able to talk about it. And then at that point, if I want a financial advisor to do my investing for me, at least I have a basic understanding of what they're doing. I'm not just abdicating. In business, we talk about delegating a lot, getting somebody to take over specific things for you so that you can be more efficient. People tend to do is they tend to abdicate, which is like, hey, I don't really want to deal with this. Let me hire somebody. Let me give it to them. Let me hope that they can handle it. And I think we do that a lot with our finances. We abdicate to others. We're like, we don't have the time for this. They're smarter than us. They have the education. They're the experts. Let me completely abdicate without even understanding the basics. And I think that is one of the challenges too here that causes people to really just be in the stock market, because at least it's accessible for us, because we're like, oh, just put money in index funds. So everybody kind of knows that. So at least they know what to do.
Well, another big reason I think is the financial services industry, right? So if you think about it, a lot of the financial advisors are not recommending these alternatives. Some of it is they may not have access. Some of it may be they don't know about them. Some of it may be they don't have experience, so they don't feel comfortable recommending it. Some of it is actually they don't get fees. right? And so that's probably a big part of it, is that they're not getting fees for it, so they don't want to recommend it. And so I think that that is a big reason why a lot of us who probably have financial advisors, we are not in these alternatives because our financial advisor is not recommending these things to us.
Right. And that's one of the challenges we've had a lot with financial advisors in real estate, because not only do a lot of financial advisors not know about real estate, but they're actively against you investing in real estate, right? Because they're not going to get their fees because they're not investing that money. And so it's almost like you can go to a financial advisor and say, hey, look across my portfolio. And they're like, oh yeah, the real estate, let's exclude that. This is really the important part of your portfolio. But if you're a real estate investor, like a lot of you guys are, that's actually a huge part of your portfolio and a huge part of your net worth. And when you're only focusing on your stocks, you're missing out on understanding that there's a lot more wealth here. And how are you optimizing that if you're just putting your financial advisors only putting their efforts into your stock market portfolio, not even taking into account your real estate portfolio. Now, again, I just want to highlight that we are talking about assets being uncorrelated. And I want to mention that again. So uncorrelated means when one goes up, the other doesn't necessarily go up. When one goes down, that doesn't mean the other one's going to go down. And this is all about protection of your wealth long term. Now, we just talked about the different asset classes. I would encourage you, if you're on the road right now or you're in the middle of doing something else, not to do it necessarily right now, but to go back and sit down and say, hey, let me look at all the asset classes I own right now. Because if the goal is to have, 10, 12, 15 uncorrelated asset classes, how many do you currently own, right? Do you own your stock market portfolio, and maybe you own a couple rental properties, right? You own some gold, maybe you own some crypto, and actually go and count them up. And actually, we've done this. We actually have a fair amount of uncorrelated assets now, but it's because we've educated ourselves and because we made an effort to be able to do that. And I also want to call attention to one other thing, is these different asset classes also have different levels of risk. And I want to make sure you guys understand that, right? So crypto is going to have potential higher returns over time, maybe, but it's also going to have dips, right? It's much more volatile than maybe the stock market is, right? The stock market overall, when you look at its lifetime, has performed at a certain rate, right? 8 to 10%. Well, what has Bitcoin done over its lifetime? The returns are far greater, but it's also had a lot of ups and downs, right? So you have to be able to be in a position to weather and understand the risks of each of the asset classes. Startup investing, we just mentioned angel investing, super risky, super, super risky, because most businesses fail in the first 5 years. And so you have to understand that, but you also have to say, hey, the upside's high enough and I can afford to take this risk, and I'm going to take this risk because the potential is much higher and I'm willing to lose this money.
Yeah, I think another important factor to kind of consider is the taxes, right? And the differences in taxes. And so things like oil and gas may have some tax benefits. You have to look into that. Certainly real estate, you guys know this from listening to us, that real estate obviously has a lot of great tax benefits. And that's huge, because not only can the value of your investment go up, but also at the same time, you're creating potential tax benefits with real estate, oil and gas, and some other asset classes.
Now, when you look at our personal portfolio, it's still a pretty big chunk of it that is real estate. I would say, close to 50% at this point. And when we started really digging into different asset classes, probably about, I'd say 6 years ago, and I would say we were 80 to 90% real estate. So we have done some diversification over time. But, why are we so passionate about real estate? Why did we make real estate such a big part of our portfolio? So number one is cash flow. A lot of the assets we've discussed that are alternative assets don't produce cash flow. You think about a startup. Like angel investing in a startup, generally you're not getting any cash flow at all. I can tell you from the startups we've been investing in many, many years, we have never gotten any cash flow at all from them. It's just a hope that at some point they get sold or they get bought out or something happens that they suddenly increase in value and you're going to have some big payout someday down the road, right? Oil and gas maybe is going to bring in some cash flow. So that's one that could do it. And also life settlements is another one that could bring in cash flow. Your stock market, unless you're getting dividends, you're oftentimes not getting cash flow from that. So you really have to understand which things are producing cash flow, which are not. And real estate for us, when we own our own rental properties, we're buying them to make sure that they're cash flowing, because cash flow is ultimately what allows you to replace your income, stop trading your time for money, and have that opportunity to, cut back, work less at your day job if you want to, or, go travel the world and have some money coming in every single month. A stock market's not necessarily going to do that for you.
Yeah, wanted to mention, private lending is another one that we've gotten into, and that also can generate some cash flow as well. So there's, as Leite said, you want to really look at all the different asset classes, all the different possibilities, and think about cash flow as a dimension, which ones produce cash flows, which one doesn't. Doesn't mean that if it doesn't, it's not a good investment. It just, you just want to define what creates that cash flow, and then depending on what's important to you, you may say, okay, I want to be heavier in things that produce cash flow. That's why a number of people in our community, in addition to investing in real estate, are actually lending money as well, because they like that kind of steady source of income. Also, if you do it well, you can actually do it with fairly low risk, where you can be the first position lender, meaning that if the borrower defaults, you get the property. Right. And because you're in that first position, you can sell the property and then you can pay yourself back, right? Make sure you get your capital back. And so you can structure it in a way where it's very safe, produces steady income.
Yeah, and that's a really great point. We should actually highlight is that, what we've done is we actually have taken one of our retirement accounts and turned it to self-directed, so we can lend to our community, to people who are doing rehabs or need cash for a cash offer or whatever. And that, does produce interest and cash flow for us. It gives people access to lower cost borrowing because we make it at a really nice rate for our community because, mostly we're contributing to our community, to be honest. But it's a really great way for all of you who understand real estate investing and can assess the risk of the deal that the person is doing to bring in a little bit of extra cash flow with your retirement accounts. Is do a self-directed account and lend to people who are investing in real estate. And as Kenji mentioned, what is like, if they default, you actually get the property. And so if you understand real estate, like, you should know ahead of time this is a good property and you wouldn't mind getting it if they do end up defaulting. And honestly, people in our community rarely default. In fact, one of our referral partners is doc to doc lending, and like, they lend to doctors, and part of the reason they're so successful is doctors do not default really compared to the average population. And so when you're in this community, I think it's a pretty low risk, at least for us, we believe it's pretty low risk, is to have that self-directed account and lend to our community members who need the money for short term and be able to produce a little cash flow and help them out into being able to rehab a property, for example. Another really important reason that we like real estate so much is because we have control. So when we own our own properties, we really have the control to change that asset and make it perform better. And so one of the things we often do is we buy properties that are performing really poorly, and we increase the valuation of that property by increasing rents, by making the property much nicer, by decreasing expenses. And ultimately what we're doing is something we call forced appreciation, where we're taking the property, we're making it worth more. We can only do that because we have control, right? And that's why why we love real estate so much, is because it allows us to use our creativity and allows us to use our skill sets and the way we think to actually add value. When you invest in most asset classes, you are investing as like a passive investor. You have absolutely no control. And that's the case as a passive investor in real estate too. But we're talking about being active investors, why we like it so much. And that control piece is a big one, because when you're competent and you really understand what you're doing and you're educated and you follow through and you execute, the returns can be so phenomenal.
Well, this is another one where even if you're investing passively in real estate, even though you're not directly controlling it, there's somebody who you're investing with who does have that control and who is increasing the value of that property. So the idea here is that if you're working with somebody who knows what they're doing and they are forcing appreciation, they're increasing the value of your investment. Contrast that with something like Bitcoin, right? Or something like crypto. You have no control. I don't think anybody has any idea whether or not that's going to go up. I think the idea is that it's a scarce resource. There's limited Bitcoin, and also the use of it is going up because people don't want their money in fiat currencies like the dollar or the euro. And so people are turning to things like Bitcoin, and the use of it is increasing over time. And so therefore, people are saying the value of that asset class is going up. But nobody really knows, I don't think. And so nobody really has any control either. And I think that's the key point here. Whereas with real estate, there is that measure of control. There's degrees of control. You can have much more control if you buy and own your own rental properties. If you're investing passively, you have less control, but you are investing with somebody who does have that control.
And that's a really great point, which is, you really got to vet that person who's running the property because they are the person who has the control, and you have to make sure they're know what they're doing. And the same actually with like life settlements. That's another one where you personally as a passive investor don't have any control, but you can invest with a group who has a track record, who has done well previously, and you have a lot of trust in how they're going to do going forward. And so there are certain alternative asset classes that there is some element of control. It's not control you have, it's control somebody else has. And when that is the case, you better make sure that you're really vetting that individual. Angel investing is another case, right? You can look at the numbers, you can really understand the market, but to some extent you're betting on the jockey is how I think of it, because you're betting on that individual to figure things out, to be resourceful, because things change in business. You have to pivot sometimes. The original idea that they have of this business may not work out. You're trusting that they're going to be resourceful enough to find a way to make this business have a valuation and continue going. So ultimately, you get that big payout at the end. So then the next one for real estate is the tax advantages. And Kenji already mentioned that to some extent. We have so many resources on this, right? We have blog articles on the tax benefits of short-term rentals, on medical office buildings, on real estate professionals. So I'd encourage you to go to Semi-Retired MD and definitely check out a lot of these resources. But the ability to shelter W-2 income really is a differentiator with real estate compared to all the other asset classes. And it's huge. It's really, really huge because that's the money that really gets taxed the most. And it really differentiates real estate compared to anything else. Now, I think a lot of you guys have heard us talk in a webinar or maybe talk on here about the 6 ways you make money in real estate. So I'm just going to review them really, really quickly, and you can go definitely check out some of our other content to go deeper into these. So we mentioned cash flow and we mentioned forced appreciation. One thing we didn't mention is the tenants paying down your mortgage, which usually gives you 2 to 3% return. Immediate appreciation, which is the inefficiencies in the market where you get to buy a property and day one, you actually end up making money because the property appraises for more than you purchase it. This is not something you get in the stock market, right? You're buying it at the same price as everybody else. So immediate appreciation is a really big one. We've mentioned the tax benefits. Market appreciation, I think in real estate is the same as what you get in all the other asset classes, right? Things will go up, things will go down. You ultimately have no control of it. But when they go up, it's really a great thing. And so as much as you can time the market, it's great. But if, ultimately, we personally just buy real estate and buy good deals no matter what the market's doing, because we're making sure that we're making money with cash flow and all the other ways as well. And so it still makes sense to buy deals, and there's still inefficiencies in the market no matter what the rest of the market is doing in real estate. So I think I covered those 6 ways, and let's keep going.
So what can we learn from ultra high net worth investors? And this is not investing advice, so I'm going to talk about it from the perspective of what we've been doing over the last 6 years, which is first educating ourselves about these different asset classes, and then starting to increase our holdings in different alternative investments. And so we had mentioned looking at things like angel investing and venture capital. So we've been investing in a number of different startups. That's one thing we've been doing. Another one we've been doing is investing in crypto and increasing our holdings in crypto.
Yeah, and like Kenji mentioned, we've also done hard money lending. Actually, we invested in private equity at one point too. So we've done a lot of different things, and that's really to have these uncorrelated assets and have a portfolio that's a little bit more likely to be able to get through any recession and any single asset losing a huge amount of value and still end up okay. Now, we've kept real estate as a big portion of what we do because of the cash flow and all the other benefits, and because we really deeply understand it and we have that element of control. But because we are now shifting our portfolio into more and more protection, right, rather than as much focused only on growth, that's why we've done a lot of diversification across the different asset classes, and also because we've gotten more access to all these things through relationships, through, just again, getting the knowledge, and you start to talk about this stuff and things open up to you. And then also with our experience with business building, we started to learn a lot more about businesses and to be able to assess the businesses that we're investing in better. But overall, I really want to reiterate, which I think is a really important point, is we're always focusing on income producing investments, right? Those are, and making sure we have those in our portfolio, because that's ultimately what's going to allow us to get to any point through any time where maybe, you lose your job or you have something happen in your life and you lose one source of your income, you want to make sure you have that backup. And I love having multiple sources of income coming in every single month. It just really gives you a lot of security knowing that you have multiple places that you're getting money. Okay, and then the last thing I wanted to mention is mindset, right? Mindset's always so important in all of these things. So it's important to know that each asset has cycles. Things will go up, things will go down. And if you have a clear view of what you're doing and where you're going and a vision for your future, and that vision is something like, hey, yeah, I'm going to own my stock market assets and I'm going to also own a diversified portfolio, and this is why I'm doing it. You're going to be able to go the long term, right? You're going to be able to get to those times where there is a recession, the stock market drops, and you're not going to freak out, right? And you're going to remember, hey, I have other asset classes, and you're going to be able to manage your mind. And so do that mindset work. Understand things are going to go up, understand things are going to go down. Sometimes crypto is going to drop a huge amount. And, you want to continue to have a long-term viewpoint and understand that, you are diversified once you've done this, and you're in a much better position than 95% of Americans who don't have this diversification at all.
Another important aspect here is identity, and really just embracing the identity that you are capable of learning about different asset classes. You are capable of being really good with finances and diversifying your portfolio so that you can weather any of these ups and downs in any one asset class, and that you can protect your wealth.
Yeah, I think this is also kind of fun. Honestly, we have our EB Pro Mastermind, and I remember when we went and we invested in this angel fund in this business that we were talking about, the startup business, and people were like, oh my gosh, I'm an angel investor now, right? This is kind of fun. It's kind of fun to go out and learn about different asset classes and diversify your portfolio and say, hey, I'm at 8 different uncorrelated assets. I'm going to get to 10. What are some other things I want to explore? It's fun. It's learning. It's trying new things. Not every single investment is going to work out well. We can tell you from that, our past experience, especially with startups, they don't all work out really well, but you keep going and you keep learning, and some are going to work out really, really well. And that's the key is you do that diversification, and you're going to have some wins and you're going to have some not wins. But overall, over the long haul, if you're focusing on those fundamentals and you're educated, you should do better and better every single year. If you're someone listening to this and you've never learned about real estate investments, you have to take Zero to Freedom. That's our introductory course on how to buy your really good deals and learn how to create this other source of income outside of your day job, so that you are in the position that if something happens to you with your day job, or you get sick, or whatever happens, that you have that other source of income. Or if you just want another source of income because you want to be able to travel the world and have that time freedom and financial freedom. Again, we've covered all the reasons we think real estate is such a really phenomenal vehicle for that. So we will put the link in the show notes to Zero to Freedom. We do it a couple times a year live. You definitely want to be part of that. So definitely join our wait list, or you can email our support team as well if you want to try to get in a little bit earlier than our general public. Okay, if you enjoyed this episode, make sure to subscribe to Doctors Building Wealth, and we'll see you next time.